Students, just a few announcements. Test 1 marks. I know I said I was going to release it during recess, but it got very busy. So what I'm going to do is I just need to capture, and I'll release by this afternoon. So you'll all know how you did, and you can also come collect your scripts. So please take note of that. In terms of content, I saw that some of you wrote on the evaluation that you would appreciate content more in advance. So what I've done is I've posted the content for the rest of the semester. Did anyone see that? Yeah, it's all online. And the reason I did that is because of your case study. So I know the case study deadline is so close to the last day when we finish our content. And because of that, I realized that it would be better if you can also start rereading and also asking questions in advance. There's no issue with that. And then regarding consults, you are more than welcome to consult as a group. I always recommend if you are consulting on your project, please let them at minimum talking about short-term insurance. The lecture content prepared is very short, so I'm just going to stick to getting through this sooner than later. So in terms of short-term insurance, we look at assets and sickness. So yes, there is a short-term policy that would fall under sickness, although we did cover it with long-term insurance, but there is a minor policy that will cover that is on short-term. Okay, in terms of an overview, the primary function is to provide protection against unforeseen events. All the policies we're going to talk about today fall under the Short-Term Insurance Act 53 of 1998. The biggest distinguishing factor between long-term insurance and short-term is the following. With long-term insurance, it's related to things that must happen. So like death, or becoming disabled, or experiencing an impairment. It has to happen. With short-term insurance, it's related to things that might happen. So like theft of your cell phone or getting into a car accident, those are things that might happen. So they are covered under the ambit of short-term insurance. So it's directly related to insuring your possessions and objects. So if we're talking about insuring our cell phones, our cars, our houses, we're looking at short-term insurance. There are 17 classes in terms of non-life insurance. So non-life is another term for short-term insurance. You just need to know that there are 17 classes. In terms of the types of policies under short-term insurance, these are the ones that exist. You can either have them on their own or you can have them as a combination of policies. So we have an engineering policy. This is a policy that relates to machinery and equipment other than a motor vehicle in the construction process. In the carrying on of a business, this would include a crane or forklift. You take out an engineering policy to insure against any liability you might experience with those assets. Then we have guarantee policies. This is taken when there's a failure to discharge an obligation, so money back guarantee on products. An example of this is where you have to, you're in a construction process, so you're building a building, and because so much money is invested at the beginning, you can take out a guarantee policy with that construction firm just in case, so that they make sure that they do comply with the requirements or finish the work that they're supposed to. So it's common in the construction field, the guarantee policies. Then we have a liability policy. The name says it as it is. It's risk related to incurring a liability. This can be professional liability or an injury on premises. We have motor policies. This is relating to the use, possession, or ownership of a motor vehicle. Then we have accident and health policy. This excludes medical schemes, benefits. This is health insurance essentially. So again, I know that we did talk about health insurance under the long term, but there are some policies that fall under short term. Then we have property policies. This relates to use, damage to removable or immovable property. We have transportation policy. This is the conveyance of goods or persons by air, land, or water storage, treatment or handling of goods. So remember, for instance, when you order online and you have goods coming that are being shipped, you have to have insurance as an entity with those goods. Because what happens if that ship doesn't make it, or it breaks down, or it sinks? So what happens to those goods of the people that are waiting for it? So that's why as an entity, you take up that type of insurance to protect yourself against that potential loss. Do you all understand that? Okay, and then we also have miscellaneous policy. So with this one, it's kind of the one that builds on if something is not covered with the above mentioned policies. So it's not covered elsewhere in the categories. So for instance, if you experience a kidnap, you have to pay a ransom, you could take up a miscellaneous policy. Then with regards to personal accident benefits, so personal accident or health policy, like I said, it excludes medical scheme benefits. This is a form of health insurance. It's issued for specified amounts for each event. The insured selects the level of cover required and covers accidental bodily injury. So that's what this covers. And then motor insurance, very, very important. So I'll start with this one. So in terms of motor insurance, there are 4 types. The first one is the Road Accident Fund. So the Road Accident Fund covers legal liability for death or injury caused by an insured vehicle. So it's important to know, with regard to RAF, every user of the South African roads is covered by the Road Accident Fund. So whether you're a citizen or a non-citizen, you are covered. How they receive their funds is by charging fuel levy and also receiving grants from the government. So I know many of you do know about huge payouts that people receive when someone gets into a car accident or when someone dies. Does this sound familiar? Yes. The way they get their money is from charging that fuel levy whenever you put fuel in your car and also receiving grants from the government. Then we have balance of third party only. So it's legal liability for damage to other person's property, passenger liability. So if I have my vehicle and I have a friend who also has a vehicle, and then we get into a car accident, if I'm covered with that category, what they'll do is they'll pay my friend's liability in terms of the accident that I've caused. So she will be covered. They'll cover her car and all the damage that she experienced. Then balance of third party, fire and theft. This is legal liability for damages to other person's property, passenger liability, plus loss of or damage to the insured vehicle by fire or theft. So again, they cover the other person's loss should they experience, but they also cover my loss if there is fire or theft on my vehicle. That's how that category works. Then with the last category, which is comprehensive motor insurance, this is legal liability for damages to other person's property, passenger liability, plus the loss of or damage to the insured vehicle by fire or theft, plus accidental loss or damage to the insured vehicle. So if you look at these categories, from your left to the right, that's how, in terms of pricing, it gets more expensive. So the more you're covered, the higher the price. So comprehensive insurance is the most expensive in this category. So when you guys start working, you might find that you will drive an entry-level car. So with your entry-level car, some of you might be lucky to get a job in, for instance, Sandton, Centurion, or all these expensive areas. In these expensive areas, you have executives who drive Porsches. What are other expensive cars? Porsches. What else? Lamborghinis. What else? You guys don't know cars. Lamborghini. What else is on the road? Bentley. All these expensive cars. So now I'm not discriminating against anyone who would drive a small entry-level car. But what happens if you with your small entry-level car crashes into a Porsche and you just started working? Do you now see the importance of insurance? So it's very important. when I was in practice, there was this so at the company where I worked, they used to outsource the IT personnel. So whenever we had IT issues, someone would come from the outside and come and assist us. So the gentleman came one day, he parked his car in our parking, and he left his handbrake down. So he left the car and then he went inside and he was helping us. What do you guys think happened? His car rolled and scratched a bunch of cars. So imagine if he did not have insurance to help him. Obviously, in a situation like that, because there's negligence, there are penalties, the insurer is not going to be too happy with you. You might find that your premium is going to change drastically because of that mistake you made. But because he has insurance, he has that peace of mind that the damage to the other cars were repaired. Yes? Insurance. So I was talking about salvage, double insurance, underinsurance. So those were principles that could be applicable to both long-term and short-term. Some things like salvage would only be applicable to short-term. So car insurance, because it relates to the possession of an item, an object, is short-term. Okay, yes? Term insurance, you want to know if there's a limit as to what you want to take out. So for instance, I'll give you an example. If I'm insuring my vehicle with Discovery, I'm just saying it for the purposes of an example. I'm insuring my vehicle with Discovery Insurance. What they will do in the process of me applying for this insurance is that they will ask me, do I want to insure at market value or retail value? So retail value would be the cost price of a brand new car. Market value would be the market value of my vehicle at the happening of some unforeseen event. So when I decide which of the two, it'll obviously affect the premium that I get on that policy. So with short-term insurance, there has to be a specified lump sum in terms of what you will get, or when there's an unforeseen event. So that's how it works. There is a limit. So I can't now insure my vehicle that's worth 400,000 Rand for now 600,000. They won't pay it out. In that regard, I would be overinsured. So there are limits. They look at the actual value of the asset or object or possession that you're insuring against. This even goes to household contents. So they ask you, what's the value of your TV, your furniture, all of that, when you apply for that type of insurance. Does that answer your question? Okay. So then we also have transport insurance. For transport insurance, I'd like that you know the forms of policies. So you have a time policy. This is for a fixed period, usually not exceeding 12 months. Then you also have a voyage policy. It's operative for the period of the voyage. For cargo, the cover is from warehouse to warehouse. So like I mentioned, when you're transporting goods, you want to insure those goods so that you don't experience drastic loss should something happen to those goods. We also have mixed policies. This covers the subject matter for the voyage and a period of time thereafter. We have building risks insurance. It covers the construction of marine vessels. We have floating policy. This provides the policyholder with a large reserve of cover for cargo. And then we have small craft. There's an increasing leisure use of small boats brought about the introduction of this form of policy. So I'd like if you just know all the forms of policy under transport insurance. Then fire and theft. So fire and other property damage insurance. So most often covers buildings, machinery, plant, and stock of a company. Fire insurance used to be classified as an exclusive risk in its own right, but today it is more likely to be grouped under the general heading of property damage insurance and the standard fire policy and property insured. So in terms of theft, it usually covers all the contents of the buildings. Underwriting is strict. So underwriting is when they're doing the assessment of how much risk the insurer is taking on should they cover the insured. So it's very strict when they ask those questions. Like with life policies, they're also strict in asking you to do your medicals, do a blood test, check your urine if you're a smoker or not. So all of those. So underwriting is just them doing their due diligence to make sure they understand the risk that they're taking on. It usually has to be accompanied by violence or force. So with theft, there has to be some evidence that there was a push or break-in or something that happened to show that there was violence or force. Theft by a member of the insured's household or an employee is not covered, although businesses may protect themselves from losses arising from dishonest staff through a special fidelity insurance policy. So if, for instance, you have your house and you want to report a break-in, but it turns out that there's no form of violence because what happened was internal, so someone within your house tried to steal something from you, it's going to be very difficult to try and claim in that regard. You usually will not be allowed to, and it's contained in the policy document when you sign up for the insurance. So most insurers actually have the clause to say, if we are protecting you against theft, there needs to be a form of violence or extreme force, and there must be evidence. That's why whenever something happens, take pictures. Because at claim stage, you want to at least make sure a seamless process. I know some of you discussed that what's the point of insurance when there's so many issues, they try to do their best to not pay out. Like I said, it is a business game, so they also have to make money at the end of the day. Your job is just to make sure you're being honest and you're fully disclosing all the information that you have to disclose with regards to the risk you're transferring to the insurer. So then all risks policies, so these tend to be more expensive. They tend to be more expensive because they're offering protection on a wider spectrum. So because of the wider spectrum, you will have to now incur a higher premium. So the types of all risk policies, for personal effects, all risk policies are popular with individuals who seek a wider protection than that afforded by policies available to cover household effects. The all risks policy can be taken out for particularly expensive items such as jewelry, cameras, or any fur coats. Business all risk policies, they cover for specific high value items, sophisticated and specialized technology. So if you're in a factory, you have a very high or very expensive item that literally produces everything that gives your business income, then you need to take up that insurance to ensure should something happen to it, you at least get the money to get it fixed or either get a new high value item. Then goods in transit provides indemnity to the owner to cover for goods lost or damaged in transit. Contractors all risk covers for damages incurred by the contractor during construction. So now construction, the amount of policies that a person has to take out in that process are quite vast. So that's why it's important to actually speak to people who are able to give you the advice that you need. Are you guys familiar with the construction mafia? Okay, the people saying yes, please raise your hands. Construction mafia. Okay, can I just ask, are you property students? No, you are, okay. All right, so the construction mafia is the corruption that goes on with the construction industry. So there's a lot, and I know a personal story from someone who has told me. What happens is there's this gentleman I know who's working on a project where they are planning to put a KFC and a bunch of restaurants in this small section of land. However, before they started the project, so when they were just clearing the land, kind of starting with the foundation, people showed up. These people showed up to their premises and they were like, we would like to be involved in this project. So it's not a question of we're asking to, we are saying we would like to be involved. So how these people work, which it's an illegal business, guys, but it's costing millions in South Africa, so you should do the research. So these people are like, we would like to be involved. Tell us, you're either going to give us a pay cut or you're going to hire our employees. So when you're in construction, you have to cater for that type of risk. It's a very unfortunate reality, and I do suggest you do some research on it. Then we also have money. So the policy provides indemnity to the insured in the event of money being stolen, either from their business premises, their own home, or while it is being transferred to the bank or from the bank. So you remember that truck that comes to collect money from business premises, and you've also seen the crime that happens with those trucks where they have people actually hijack them and steal or kill the drivers and actually collect that money. Remember, as a business, when we're putting that money into those cars to transport to the bank, in most cases, they are taking money of the wages of our employees. So the salaries of our employees are being taken to the bank. If you do not have insurance on that money, how are your employees going to be paid? How are costs going to be covered? So that's why it's very crucial to consider money insurance. Then glass and engineering. So glass cover is available against accidental breakage of internal and external plate or float glass in windows, doors, and showcases. Engineering relates to possession, use, or ownership of machinery and equipment, the erection of buildings or other structures, or the undertaking of other works, or the installation of machinery or equipment. So if you're hiring a company and you're like, okay, we want to include this machinery in our factory, and they bring it, and it's very expensive, and while they're installing it, it damages. What happens if you do not have cover? So this is where cover becomes important. Then liability insurance. So employer's liability is limited to work outside of the country, as the Compensation for Occupational Injuries and Disease Act 130 of 1993 addresses local requirements only. Public liability provides compensation for those who may need to pay damages and legal costs for mishaps. Product liability and defective workmanship. So example of injured by products purchased in a company, for instance. Then professional liability relates to professional negligence. Example, doctors, lawyers, even financial planners or wealth managers. So there was this story about a child who was, so there was a lady who gave birth to a child in a hospital. But because of the way the birth process happened, this child came out with a deformity. So they were, as a result of the birthing process. So it wasn't genetic, it wasn't any of that. It was the child, because of how they handled the birth, they came out with a deformity. So this lady was a single mother. The father abandoned her, said he did not want any involvement, and that was it. And this lady, because the child came out with this deformity, and she also went through a lot of emotional pain and heartbreak, she just struggled and decided, I can't raise this child. It's too painful for me. So what happened in this case was the mother, which is the lady's mother, decided to take in that child and actually care for the child. The child later died, I think around 5 years or 6 years, and there was a payout from the hospital. The payout was due to the fact that there was a malpractice. Like I said, child got the deformity from the birthing process. So there was a huge payout of millions, and now because money was involved, the matter was taken to court because the biological parents of that child now wanted to claim some of that money. Now, because law of succession and all of that, and also because the matter was heard in court, what had happened was the grandmother is the person who received the money. Do you all know that story? Okay, so she was the one who received that money. So what I'm trying to build on insurance is that hospital had to take up that insurance for that malpractice suit. If they do not have the insurance for those potential malpractice suits, they'll end up having to tap into reserves and end up having to close business because they can't afford to always tap into what they have to make these payouts. Yes. Which one? Employer's liability. So an employer is required to protect themselves in terms of certain losses that they can experience. So for instance, if we're talking of construction and we have a situation where an employee who is climbing on a building or trying to construct something really high, and let's say they fall and they experience bodily injury, the employer needs liability in order to help that employee because now it's under their premises in which they need to be covered. No, it doesn't. It doesn't protect outside of South Africa. So outside the borders, it's not protected. Other types of insurance, we have credit and suretyship insurance. So credit is losses by reason of insolvency of debtors. So for instance, if you purchase a house, like I mentioned, you have to have an insurance policy attached to that mortgage bond so that should something happen to you, the bank is able to recoup their money. The only thing that you needed to know there is that if you're purchasing a house, you as the consumer are entitled to a free choice to use an existing policy, a new policy, or the combination of both. So when you purchase a house, the banks need their money. You heard Akona when he mentioned that when you die, the people who first start collecting their money are the banks. So should you have that insurance, then that insurance will cover that debt. I also just want to touch on this one. When you purchase a car and you take up comprehensive insurance cover, comprehensive insurance cover only covers your vehicle in terms of damage. So damage to your vehicle or damage to anyone else's vehicle. But comprehensive insurance cover does not cover that debt that you have with the bank. So it's two separate things. You have the cover for your vehicle and then you have debt on its own. So with the debt, you would consider taking on an additional policy to pay out should something happen to you. Yes, with cars, the terms are shorter, so it's not like a mortgage bond, which is 20 or 30 years. With cars, it's about 6 or 7 years. Within those 6 or 7 years, something can happen to you. And you want to make sure that if something happens to you, at least the debt in terms of the car is covered. So you do have to take up a policy. There's no obligation element to it, so they don't tell you you have to. It usually is optional. You have to actually decide for yourself, am I covering that debt, or do I believe that I'll be fine and I'll live for the next 7 years when I'm paying off that car? Okay, then interruption insurance. This is the insure against loss of income resulting from damage to property. So you all remember that time that there were riots and looting? Do you remember that? Yes. So many of the companies had to take up or were making claims in terms of interruption insurance. So some of my colleagues were actually doing research on this to see how many claims or how many people were actually receiving payouts in respect of interruption insurance. Remember, you get interrupted. Now you can't conduct your normal trade and receive your regular income. So that's why it's important to have this insurance. Then other types of insurance, this I just suggest that you can read through this as well, but this is very important. So in terms of principles, we have two very important principles. We have excess and franchise. So excess is where the insured is obliged to accept liability for a part of the loss. An example is an excess of 2,500 Rand. This means the insured has to pay the first 2,500 of any claim. So if I have an excess on my motor vehicle insurance policy of, let's say, 8,000 Rand, and now I get hijacked, God forbid, what I'm going to be required to do before I can receive that payout from the insurer is pay the excess. So I have to pay that first 8,000, and then they'll pay me with the additional that's left for my vehicle. Then with regards to franchise, it kind of works in the opposite direction. It's also a form of self-insurance for part of the loss, except here, the insurer will pay in full if the franchise amount is exceeded. So for example, 2,500 Rand franchise means that the insured has no cover for losses less than 2,500. But losses in excess of 2,500 will be covered in full by the insurer. So do you understand that the two kind of work in an opposite effect? Where you will find this is on your policy document. So you need to read through the terms and conditions of claim, because they will say you have an excess. Excess being that you have to pay this amount before we cover anything. So very important. Someone raise their hand? Yes. That's how it works. That's the principle that they would include in the policy document. And that's how it works. It is a good question. So what you'll find is in the claim process, if you're with a good insurer, they know that what you just said. And what they'll do is they'll say, okay, because your loss is this amount, we can actually knock it off. But it's just important that you know, if you have an excess of this amount, you have to take it out from your pocket. So with claim stage, it's kind of dependent on the insurer and what their practices are. Yes. Pay, okay, when you're paying it, it's because they're accepting the claim. So, okay, maybe elaborate further what you mean on denying. Are you saying that you pay 2.5 and it stays with them and they don't help you? No. Maybe you what? Or you committed fraud or something like that. Then you wouldn't even get to a stage of having to pay. Yeah. Yes.
Are they not the same?
Sorry?
Are they two principles?
No, they're not.
But it says you first need to make a payment of 2,500.
Yes, I understand. They sound very similar, but they're not the same.
What's the difference?